Welcome to the Deep Dive. We take complex source materials and, well, we break them down to give you the core insights, fast. Today, we're really pulling back the curtain on the Indian cinema scene. We're looking at the latest numbers from PVR Inox Ltd. We've got their unaudited, consolidated results for Q2 and the first half of fiscal year 26. So that's everything up to the end of September 2025. And look, these reports, they're not just showing a comeback. They might actually be signaling a real structural shift in the cinema business post-COVID. So our mission here for you is pretty straightforward. PVR Inox hit their highest revenue, EBITDA, and PAT in the last 2 years. Was that just, a flash in the pan, driven by a couple of mega movies? Or is something more fundamental going on, like a real changes in audience behavior or company strategy? Okay, let's get into it. Let's unpack this financial blockbuster.
Yeah, it really jumps out from the documents that this isn't just luck. Management's definitely framing it as execution, as a structural thing. So to start, we got to look at the headline numbers, but there's a key adjustment we need to make for Ind AS 116.
Okay, hang on. Ind AS 116. For those of us not swimming in accounting standards daily, why does that specific one matter so much here?
Right. It's all about leases, how they account for their cinemas, basically, since most are leased properties.
Yep.
If we adjust for that standard, we get a much cleaner picture of the core operational profit. It separates out the rent accounting impact from how well the actual movies and popcorn are doing. And when you do that, for Q2 FY26, the total adjusted revenue is, well, it's huge. $18,432 million is the highest they've seen in 2 years. But the really stunning part, the bottom line, profit after tax, or PAT, it hit $265 million.
Wow.
Yeah. Compare that to Q2 last year, FY25. It was just $224 million. So it's a massive, massive jump.
And zooming out to the full 6 months, that first half of the year, H1 FY26, that recovery story, it just gets clearer, doesn't it?
Absolutely. H1 total revenue, $33,311 million. Again, best in 2 years. But look at that profit turnaround. H1 FY26 closed with a PAT of $929 million. Now think about this. Just the year before, H1 FY25, they posted a loss, a big one, negative $1,142 million.
Oof.
Exactly.
Yeah.
So going from over $1 billion rupees in the red to nearly $1 billion in the black in just 1 year. That tells you something profound has changed in the health of this business.
Okay, that's definitely healthy. But why is it so healthy? If profit is soaring, what's actually driving it operationally? Are they just hiking ticket prices like crazy? Or is it all about selling more expensive nachos? Let's look at the basics. Bums on seats and what they buy. Footfall and consumption.
Footfall admissions, that's the bedrock, right? And the growth there is solid and sustained. Q2 admissions hit 44.5 million people. That's up 15% compared to the same quarter last year. And for the half year, 78.5 million admissions, up 13% year on year. The report literally calls it the highest admissions in the last 2 years.
That many more people coming through the doors, that must really boost their efficiency metrics, right?
It really does. Occupancy, for instance. In Q2, it jumped significantly, 302 basis points year on year, landed at 28.7%.
Right, 302 basis points. So just over a 3 percentage point increase in how full the cinemas are. That's pretty good. But here's a question then. If admissions are that strong, why did the average ticket price, the ATP, only nudge up a little? It was $262 in Q2, only 2% growth. You'd think with high demand, they might push prices harder.
But see, that looks like a deliberate strategy. They're balancing volume with value. Sure, premium formats support higher prices, but they seem focused on keeping the core cinema experience affordable enough to drive those massive footfall numbers. It's a balancing act. And look at spend per head SPH, that's your food and drinks. That reached 140 in H1. That is up 4% year on year, which is solid. So people are spending a bit more once they're inside. But that modest ATP growth, it feels intentional.
And that connects directly to something management talked about, right? That affordability push. They actually lowered prices on some tickets.
Exactly. There was a GST reduction from 12% down to 5%, but only on tickets priced at 100 or less. And PVR Inox, according to the source, passed that saving entirely onto the customer. The example given is their Blockbuster Tuesdays deal. It dropped from 99 down to 92.
Okay.
So yeah, they're ensuring that while, the IMAX ticket might cost a bit more, they're not pricing out the regular moviegoer. That protects that crucial admission growth.
Which brings us squarely to content, because you need something people actually want to see. Usually we think of the Indian box office. It lives and dies by, 3 or 4 huge festival releases a year. But this report seems to suggest something different happened this time.
Yes. This is the real aha moment, I think, and maybe the core of that structural shift we mentioned. Management explicitly says H1 success was driven not by just a few mega blockbusters, but by, quote, a steady and diverse slate. And here's the proof point for you. In the first half of FY26, 22 different films crossed the Euro-core mark at the box office. 22.
22. Films hitting that benchmark. What does that actually mean for PVR Inox as a business? Is it just more movies doing okay or something deeper?
It's much deeper. It fundamentally changes their risk profile. Think about it. They're no longer banking everything on, say, two huge star vehicles landing perfectly on one holiday weekend. They've spread their bets across dozens of films that perform solidly if one underperforms, while there are 21 others helping to carry the load. It makes their revenue and cash flow far more predictable, less boom and bust than maybe it used to be.
Okay, let's dig into that mix then. What was working? What stood out in Hindi cinema, for example?
Consistency seems to be the word. Yes, they had big anchors like Saiyaara reportedly hitting 400 crore and Mahavatar Narsimha crossing 300 crore. Huge numbers. But what balanced the slate were other strong, star-driven commercial films like War II and Jolly LLB3. It wasn't just one or two carrying the whole industry. It created a more regular flow of appealing content.
And Hollywood, still a big factor.
Yeah. Oh, absolutely. The report notes Hollywood films collectively grossed over 500 crore just in Q2. Titles like The New Jurassic World, The Conjuring entry, Superman.
Yeah.
It shows the Indian audience appetite for those big global franchises is still very strong, very sustained. And for PVR Inox, that's valuable because those often play best in their premium formats, commanding higher ticket prices.
But the part that feels like a really significant shift, maybe the biggest signal, it's the regional cinema growth. It sounds like the map of Indian cinema is genuinely being redrawn.
It really is. Regional films are not some sideshow anymore. They are major economic drivers for the exhibition sector. Look at the numbers cited. Canada cinema grew over 100% year on year. That was led by a film called Su From So, apparently a massive hit.
Wow, 100% growth. That's phenomenal. How does a national chain like PVR Inox even adapt to tap into that kind of like super localized demand?
Well, they have to be nimble. Adapting screen allocations, local marketing. It's key. And look at Malayalam cinema. They grew nearly 50%. They mentioned Loka.
Yeah.
Chapter 1, becoming the highest-grossing Malayalam film ever, crossing 180 crore. So what this means is PVR Inox is operating less like a single-language chain and more like a platform for multiple strong content industries.
Yeah.
If Bollywood has a slow quarter, maybe Canada or Malayalam or Tamil or Telugu can pick up the slack. It adds resilience.
Okay, so you've got this diverse slate bringing in, 78 million people in 6 months.
Yeah.
Advertisers must love that kind of consistent audience. What do the numbers say about ad revenue? Is corporate confidence back in cinema as an advertising medium?
Confidence looks like it's through the roof, actually.
Mhm.
Ad income in Q2 hit 1,256 million. The report calls that the highest post-pandemic Q2 ad income. It's up 15% year on year. And interestingly, they say it was driven by longer, more sustained ad campaigns, which suggests advertisers believe the audience isn't just showing up for one big opening weekend anymore. They trust that the diverse content slate delivers eyeballs consistently across the whole quarter.
That strong, reliable cash flow, that must be the engine driving their other big focus,
Yeah.
getting their finances in order. Let's talk debt.
Yeah, the deleveraging story is, frankly, remarkable. Net debt is now down to 6,188 million. That's the lowest it's been since the PVR Inox merger completed. Put it in perspective, that's a 57% reduction in net debt. They've paid off 8,116 million since the merger. That is substantial.
Okay, the source says robust operating cash flow drove this debt reduction. Fair enough. But isn't the content pipeline always a bit cyclical? Movies boom, movies bust. How sure can we be that they can keep paying down debt at this rate if, say, next year's movie slate isn't quite as strong?
That's exactly the right question. And the answer seems to lie in their spending discipline, specifically on capital expenditure, or CapEx. They're not just using the good times to pay debt by, stopping all growth. They're changing how they grow. They've significantly reduced their overall CapEx intensity. They're leaning hard into what they call a capital light expansion model. Capital light model. Okay, what does that mean practically? How do they add new screens without spending huge amounts of their own cash? It means finding partners. They currently operate 1,761 screens in 111 cities. That's a big footprint. They did add 42 new screens in the first half of this fiscal year, but the pipeline, the next 132 screens they've signed deals for, that's where this capital light strategy really shows. 44 of those are under a FOMCO model, franchise-owned, company-operated. Essentially, a developer or partner builds the cinema infrastructure, pays for it, and PVR Inox just comes in and runs it.
Ah, okay. Less upfront cash needed from them.
Exactly. And the other 88 screens are under a broader asset-light approach, likely similar partnership structures. This lets them grow their reach, add screens, but preserve their cash flow to keep hammering down that debt. It makes the balance sheet much less vulnerable to the ups and downs of the box office cycle.
So, strong current momentum, this diverse content engine, plus that financial discipline. It sounds like management feels pretty good about the rest of the year.
They certainly project confidence. The managing director, Ajay Bijli, is quoted saying the outlook for the rest of FY26 is highly encouraging. He points directly to those value offerings we discussed, keeping things affordable, and this continued focus on capital-light growth.
And looking just ahead, the upcoming movie slate seems to back that up. For Hindi cinema, you've got potentially big ones like Tama, Tarish Ishmain, Love and War, and Border 2. That's a sequel people will be watching closely. Hollywood's bringing heavy hitters too. Avatar, Fire and Ash, another Predator movie. Those are global event films.
And crucially, the regional pipeline looks strong too, maintaining that diversity. They list upcoming films like Raja Saab, Toxic, Akanda 2. It reinforces the narrative. This isn't just about one industry anymore. It's about depth across multiple language markets. That seems to be the strategy.
Right. So boiling it all down, what's the key takeaway for you, our listener? It seems PVR Inox's record performance right now is really being powered by two big things working together. First, this steady flow of diverse content from Bollywood, Hollywood, and increasingly strong regional cinema that's driving consistent footfall and reducing their old reliance on just a few mega hits. And second, there's some serious operational and financial rigor. They're using the cash generated to aggressively cut debt, enabled by this smarter capital-light way of expanding.
Which leaves us with a pretty important question for you to chew on looking forward. We've seen how content diversity, especially with regional films and more mid-level hits stepping up, has become this new engine for the box office. It seems more sustainable, maybe less risky than before. But the challenge now becomes, how does the industry, PVR, Inox, and others make sure that all these different content streams, Hindi, regional, Hollywood, stay consistently strong enough year after year, especially with streaming competition always there? How do they ensure this new, diversified model holds up and isn't just another phase before the next disruption?
That is a great question, and probably the one that will define the Indian cinema landscape for the next few years. Okay, that wraps up this deep dive. Hopefully you feel up to speed on PVR Inox's recent success and maybe have a clearer view of the bigger shifts happening in the market. Thanks for joining us.